Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Ever wondered how S-Corp distributions work? Well, you're in the right place to find out. S-corporations, often simply called S-Corp, are a distinct type of business structure in the United States. They provide unique benefits like pass-through taxation, which allows profits and losses to flow directly to shareholders without being subject to corporate taxes. But here's where it gets interesting. S-Corp distributions. These are payments made by the corporation to its shareholders, essentially serving as their income from the business. Unlike salaries or wages, these distributions are typically not subject to employment taxes, making them a potentially tax-efficient way for shareholders to profit from the business. However, it's not all smooth sailing. There are specific rules and regulations surrounding S-Corp distributions, and understanding them is key to avoiding potential pitfalls. So buckle up as we take a deep dive into understanding S-Corp distributions. Before we delve deeper, it's crucial to understand the basics of S-Corp distributions. In the world of S-corporations, distributions are essentially the company's way of sharing profits with its shareholders. Think of them as your slice of the pie once the company has paid all its bills. One of the most appealing aspects of S-Corp distributions is that they're generally not subject to self-employment taxes. This differentiates them from the salary or wages you might earn as an employee. These distributions are, in essence, a return on your investment in the company, and the Internal Revenue Service views them as such. But it's not all about receiving your share of the profits and avoiding self-employment taxes. There's also the matter of reporting these distributions. You might be wondering, where do these distributions show up? Well, they're reported on your individual tax returns, specifically on Schedule K-1. This form provides a detailed account of your share of the corporation's income, deductions, credits, and other items. However, it's important to note that while S-Corp distributions can provide a tax advantage, they shouldn't be used to avoid paying a reasonable salary to those who provide services to the corporation. The Internal Revenue Service expects you to pay yourself a fair market salary before taking any distributions. This is known as the principle of reasonable compensation, and it's a critical part of maintaining your S-corporation status. In other words, don't get too carried away with the benefits of S-Corp distributions. They're a fantastic tool for sharing profits and achieving potential tax savings, but they are not a loophole to dodge paying a fair salary. Remember, the goal here is to operate within the rules and regulations set by the IRS. This ensures your S-corporation remains in good standing and you, as a shareholder, continue to reap the benefits. Now that we've covered the basics, it's time to dive into the step-by-step process of S-Corp distributions. S-Corp distributions may sound complex, but they don't have to be. Let's break it down. First things first, we need to understand that S-Corp distributions are essentially the company's way of sharing its profits with its shareholders. It's like getting a slice of the pie you've invested in. But how is that slice determined? Well, the first step in the process is calculating the company's profits. This involves subtracting the company's total expenses from its total revenue. So, if a company makes $1 million in a year and spends $700,000, the profit would be the remaining $300,000. Once the profit has been calculated, the next step is determining the distributions. This is where things can get a bit tricky. Unlike C corporations, S corporations don't pay corporate income tax. Instead, the profits are passed through to the shareholders, who then report these profits on their individual tax returns. The amount each shareholder receives is based on their percentage of ownership. So if one shareholder owns 50% of the company, they would receive 50% of the profits, or in our example, $150,000. However, it's important to note that not all profits are distributed. Some may be retained by the company for future investments or to cover future losses. This is a decision typically made by the company's board of directors. Now, on to the reporting. S corporations are required to report their profits, losses, and distributions to the IRS using Form 1120-S. This form should include a Schedule K-1 for each shareholder. The Schedule K-1 is a bit like a report card for shareholders. It details each shareholder's share of the company's profits, losses, and distributions for the tax year. This information is then used by the shareholders when filing their individual tax returns. Remember, even if a shareholder does not receive a distribution, they are still required to report their share of the company's profits on their tax return. This is because the IRS considers these profits as income, regardless of whether they are actually distributed or not. It's also worth noting that while distributions are generally tax-free, they can become taxable if they exceed a shareholder's basis in the company. The basis is essentially the amount of money a shareholder has invested in the company, plus any profits that have been reported but not distributed. So, if a shareholder has a basis of $100,000 and receives a distribution of $150,000, the excess $50,000 would be subject to capital gains tax. And there you have it, the process of S-Corp distributions broken down step by step. While S-Corp distributions can provide significant tax advantages, there are also common pitfalls to avoid. One of the most common mistakes that can lead to a muddle is not paying reasonable compensation to shareholders who are also employees. The Internal Revenue Service, or IRS, expects that if a shareholder provides services to the S corporation, they should receive reasonable compensation. This means a salary that aligns with industry standards for the work they're doing. If you skip this step, it can raise red flags with the IRS, potentially leading to audits and penalties. Another frequent misstep is taking too much in distributions. While it's tempting to take more distributions to avoid employment taxes, this can put you in hot water with the IRS. The key here is balance. Take a reasonable salary and balance it with distributions. This way, you're not only in compliance with the IRS, but you also avoid paying unnecessary additional employment taxes. Equally significant is the mistake of not properly documenting distributions. You see, S corporations are required to keep careful records of all income, deductions, and transactions, including distributions. If these aren't accurately documented, it can cause confusion and discrepancies when it's time to file your tax return. Remember, proper documentation is your best defense in case of an audit. It's also crucial to avoid mixing your personal finances with the corporation's finances. Even though S corporations pass through profits and losses to shareholders, it's important to keep personal and business finances separate. This prevents any confusion about what is a distribution versus what is a personal expense. Lastly, don't ignore state tax laws. While S corporations provide federal tax benefits, individual states have their own rules. Not understanding your state's tax laws can lead to unexpected tax liabilities and penalties. So, always make sure you're familiar with your state's specific S corporation regulations. By avoiding these common mistakes, you can maximize the benefits of S-Corp distributions. Now that we've covered the ins and outs of S-Corp distributions, let's recap what we've learned today. We started off by introducing S-Corp distributions. This is a way for business owners to extract profit from their company without having to pay self-employment tax. It's a key aspect of S corporations, which are a special type of business entity in the United States that offer certain tax advantages. We then moved on to the basics of S-Corp distributions. These are not subject to employment taxes, unlike salaries or wages. However, they are subject to income tax, and the rate varies depending on the shareholder's tax bracket. It's important to remember that while S-Corp distributions can offer tax savings, they must be done in conjunction with reasonable compensation for the shareholder employees. Next, we dive deep into the step-by-step process of S-Corp distributions. This starts with determining the amount of distribution, which is based on the company's net income and the shareholder's percentage of ownership. The distribution is then reported on the shareholder's personal tax return, and the appropriate income tax is paid. We also discussed some common mistakes to avoid with S-Corp distributions. One big pitfall is taking too much in distributions and not enough in salary, which can raise red flags with the IRS. Another common mistake is not keeping accurate records of distributions, which can lead to confusion and potential tax problems down the line. In conclusion, understanding S-Corp distributions can save you a significant amount of money in taxes, but it's not without its complexities. It's important to have a good grasp of the basics, to follow the correct process, and to avoid common mistakes. Armed with this knowledge, you're now ready to navigate S-Corp distributions like a pro. Remember, it's your business, and understanding the financial aspects is key to your success.